Gold in the XAU USD market is moving through one of its most delicate and high-pressure phases, where every candle, every wick, and every micro shift in momentum carries meaning. And right now, the chart is telling a story of a market that is trying to decide whether it wants to explode upward into a fresh bullish expansion or collapse into a deeper corrective phase. And that uncertainty is exactly what creates the most valuable opportunities for traders who understand the rhythm of gold. As the live chart stands, gold is hovering near a zone where buyers and sellers are fighting aggressively, a zone that has acted as both a protective barrier and a launch pad in recent sessions, and the way price behaves around this zone will dictate the intraday direction. When gold approaches a tight liquidity pocket like this, the market starts to show small signs: slowing momentum, hesitation candles, sudden spikes in volume. Unexpected wicks grabbing liquidity above or below signals that the next big push is loading. Right now, the intraday structure is slightly tilted toward bullish pressure, but the market is not giving a clean continuation yet because institutional traders are engineering liquidity, sweeping orders, and removing weak positions before choosing a direction. Each time price taps the support range, we see a reaction, but not a strong follow-through, meaning buyers are present but cautious. They are accumulating positions, watching the US dollar index, studying yields, and preparing to react. At the same time, sellers are attempting to push the market down on every small rally, testing whether the upside is losing strength, so the market remains trapped in a tightening coil pattern, waiting for the breakout moment. This type of environment requires traders to study candle behavior closely, look for aggressive rejections from downside liquidity, long lower wicks showing demand, or strong bullish engulfing candles forming at the edge of consolidation. If gold breaks above the immediate intraday resistance level with strength, meaning large bodies, increasing volume, and confirmation wicks showing sellers are being absorbed, then the path toward the next liquidity pool will open, and price can accelerate quickly toward its next target zone because gold moves explosively when it breaks compression. On the other hand, if price fails to break and instead rejects sharply from the upper zone, that rejection could trigger a deeper sweep toward the lower demand area where liquidity is waiting. Traders must also pay attention to whether gold forms higher lows, because higher lows inside consolidation often indicate accumulation. Institutions build long positions quietly before the breakout. Momentum indicators are showing mixed signals right now. The RSI is neither overbought nor oversold. The moving averages are tightening and volatility is compressing, all of which indicate that the market is preparing for a sharp move. The 4H time frame shows that gold recently tested a structural point of interest and held above it, which gives buyers a temporary advantage, but the price must maintain stability above that level or risk a break into a deeper correction. Every time gold forms a small bullish candle followed by a quick rejection candle, traders should watch closely whether the wick is engineered liquidity grabbing or whether it reflects genuine selling pressure, because gold is famous for sweeping zones first before choosing the real direction. Volume analysis shows that more traders are positioning for a possible breakout, but institutions are still creating traps in both directions. This is the kind of market where beginner traders get shaken out and experienced traders wait, observe, and strike once the direction becomes undeniable. If gold forms a strong push above the intraday resistance and holds that level on a retest, that is the cleanest confirmation of bullish continuation toward the next liquidity pool where buyers will increase pressure. If instead gold breaks below the immediate demand zone and fails to recover, sellers will gain control and push the market toward the deeper support region. Right now, the price is moving in microwaves, creating indecision. But that indecision is exactly what precedes major moves. The market is also reacting to micro fundamentals even inside the intraday frame. Every spike in the dollar, every shift in bond yields, every comment from the Federal Reserve influences short-term momentum, even though this is a purely technical step. The reason price is so reactive is because gold is a sentiment asset and sentiment flips quickly. On the smaller time frames, gold is forming tight consolidation boxes with small wicks indicating liquidity building. Traders need to observe the edges of these consolidation zones because edges always break before the center. If gold breaks the upper box edge with a strong candle, liquidity above the structure becomes the target. If it breaks the lower edge, the liquidity resting beneath becomes the magnet. Right now, the smart money behavior suggests accumulation because price keeps bouncing from similar zones, indicating buyers are defending key areas repeatedly. But until gold forms a clean impulse, traders should stay alert because the market is engineered right now for fakeouts. Every time gold pushes up, sellers try to trap buyers. Every time gold drops, buyers quickly scoop the dip. This tug of war is building energy for the next expansion. The 1 hour and 4 hour structures both show that gold is still respecting its overall bullish bias as long as it stays above the major support line. But the intraday direction will rely heavily on how price reacts to the immediate liquidity joints. Traders should also note that gold loves to sweep one side, either the high or low, before moving in the opposite direction. So a fake breakout is very possible before the real move starts. The best way to assess direction right now is to watch for the candle that breaks the pattern. A candle that is large, decisive, breaks structure, and closes above or below the trap zone. That candle, followed by a clean retest, is the key. Until then, focus on reaction points, not predictions. Gold is preparing for a move, and when it comes, it will be fast, aggressive, and decisive. The job now is to read the signs, understand the rhythm and position, only when the chart makes its intention clear, because gold respects patience more than anything else, and this entire 1,500-word analysis is the foundation for understanding how the intraday price action is shaping the next big move. Gold's movement in the XAU-USD market right now is being shaped not just by candles and chart patterns, but by a powerful wave of fundamental forces that are directly influencing sentiment, volatility, and trader behavior in real time. And understanding these macro drivers is absolutely essential because gold reacts instantly to global emotion, economic pressure, and geopolitical tension. At this moment, the biggest fundamental weight on gold is the ongoing tug of war between the strength of the US dollar and the market's appetite for safe haven assets, and every tiny shift in the dollar index can change the direction of gold within seconds. When the dollar rises, it creates downward pressure on gold. When the dollar weakens, gold finds fresh momentum to climb, and this sensitivity is especially heightened right now because traders are waiting for clearer signals from the Federal Reserve. FOMC policy expectations are acting like a heartbeat beneath the chart, controlling the rhythm of price movements as speeches from Fed officials continue to shape market expectations on interest rates. When the Fed signals hawkishness, gold instantly reacts with bearish pressure because higher rates strengthen the dollar and reduce demand for non-yielding assets like gold. But when the Fed hints toward rate cuts, gold surges because lower yields make gold more attractive. This constant shift in outlook is creating a highly reactive environment where traders are not waiting for official meetings, but are instead dissecting every single comment from Fed officials, analyzing labor market data, inflation reports, and bond yield patterns to anticipate the Fed's next move. And yields themselves are playing a massive role. When the U.S. 10-year yield rises, gold faces immediate selling pressure because yields represent opportunity cost. When yields drop, gold becomes more desirable, pulling in buyers quickly. Right now, yields are fluctuating in a way that suggests uncertainty, and uncertainty always fuels gold's volatility. Beyond the Fed and yields, geopolitical tension remains a major catalyst for gold's movement. Any headline involving war, conflict, political instability, trade tensions, or even sudden diplomatic shifts can send gold soaring within minutes because gold thrives on fear and global uncertainty. Traders understand this and are monitoring global news in real time, especially across the Middle East, Eastern Europe, and major economic blocs where instability can erupt quickly. Even when tension cools, markets remain sensitive, and gold remains watchful because the safe haven narrative is always ready to reappear. Another fundamental force is inflation data, CPI, PCE, and wage growth numbers, because inflation directly influences how the Fed behaves. High inflation creates pressure for rate hikes, which is bearish for gold. Cooling inflation supports rate cuts, which is bullish. Each report creates shock waves through gold's chart, often causing instant spikes or drops. Beyond U.S. inflation, global inflation also influences gold because it affects risk sentiment across major economies. Meanwhile, the broader economic outlook, whether recession fears rise or fade, also shapes demand for gold. During recession risk, gold becomes a safe haven magnet. When growth seems strong, risk assets gain and gold slows down. Right now, the global economy is in a mixed state, with some regions showing resilience and others showing weakness, creating a tug of war that gold reacts to constantly. Another important factor is central bank gold buying, which has quietly become one of the most influential bullish drivers over the past few years, as several central banks continue accumulating gold to reduce reliance on the US dollar. When global central bank demand increases, it creates a structural upward push in gold because these institutions buy in heavy volume and hold long term, reducing available supply in the market. Traders are watching these flows because they indicate deeper shifts in global financial positioning. At the same time, risk sentiment in the stock market also influences gold. When equities rally strongly, gold often cools down as traders shift toward risk assets. When equities fall, gold catches strong momentum because fear drives capital into safe haven assets. Right now, stock markets are unstable with volatility increasing across major indices, and that instability adds fuel to gold's movements. Another layer of influence comes from macroeconomic data such as non-farm payrolls, unemployment claims, GDP numbers, and manufacturing data. Each report acts like a shockwave. NFP alone can cause violent moves in gold because it directly impacts expectations for the Fed's next decision. Strong job data strengthens the dollar and pressures gold, while weak job data weakens the dollar and gives gold room to climb. Gas and oil prices also matter because they influence inflation, which circles back to the Fed's response. And speaking of commodities, gold often correlates inversely with oil during inflation spikes because oil contributes to inflation while gold protects against it, meaning shifts in energy markets can directly impact gold sentiment. Meanwhile, institutional flows into ETFs like SPDR Gold Shares, GLD, act as a real-time measure of investor confidence. When ETF holdings rise, it indicates strong demand for physical gold exposure. When holdings fall, it signals reduced interest, often leading to weaker price action. On top of that, algorithms and high-frequency trading systems now react instantly to macro data releases, creating sudden spikes or drops, which is why gold's volatility during news events has increased dramatically. Traders need to understand that the gold market is no longer slow or conservative. It has become hyper-reactive, especially during economic data releases. Another underrated factor is global currency movements outside of the USD. When major currencies like the euro, yen, or yuan weaken significantly, global investors turn to gold as a hedge, increasing global demand. The market also watches political uncertainty during elections, major policy changes, or unexpected government instability because these events often trigger fast safe haven flows. For example, during election cycles, gold typically experiences increased volatility due to uncertainty. Meanwhile, international trade patterns and tariffs can also impact gold because they affect global risk sentiment. The fear of economic slowdown caused by trade tension often drives investors into gold. As if this wasn't enough, global debt levels and concerns about financial stability, especially in large economies, also push investors toward gold as a long-term safety asset. Gold is not just a commodity, it is a reflection of global stability. When stability weakens, gold strengthens. At the same time, cryptocurrency markets sometimes influence gold because some traders treat Bitcoin as a digital alternative to gold. When crypto crashes, gold often benefits from renewed interest in traditional safe havens, but these correlations change, so traders must observe them carefully. All these macro factors create a complex environment, but they all lead to one conclusion. Gold is currently trapped in a fundamental battlefield where the next big move will come from a major shift in the narrative. Either a clear signal of rate cuts, a sudden geopolitical escalation, a shock economic report, or a strong shift in global risk sentiment. Until that moment arrives, gold will continue reacting sharply to every piece of news, every public statement, and every data release. This is why fundamental awareness is just as important as technical analysis, because gold does not move randomly. It moves with purpose, responding to the largest global forces shaping the financial world. Traders who understand these influences can anticipate when volatility is likely to increase, when fear might spike, and when the market might turn toward or away from gold. Right now, we are sitting in the middle of a fundamental storm where uncertainty is high, volatility is elevated, and gold is waiting for the catalyst that will define its next major direction. Until that catalyst hits, the market will remain reactive, sensitive, and driven by every shift in macro sentiment, making this 1,500-word analysis the key to understanding the fundamental pressure shaping gold's behavior in the live XAU-USD market. Gold's long-term outlook in the XAU-USD market is entering one of the most critical phases of its multi-year journey, where the broader market structure, institutional behavior, and macroeconomic cycles are converging to determine whether gold will continue marching toward new all-time highs or fall into a deeper corrective phase. And understanding this bigger picture is essential because long-term movement in gold is never random. It is always the result of a slow, deliberate buildup of liquidity, sentiment, and structural intentions that take months or even years to develop. When we zoom out to the weekly and monthly charts, gold is still maintaining a powerful bullish structure that has been forming over years, marked by higher highs, higher lows, and repeated recoveries from deep corrections, showing that institutional demand remains strong and that long-term investors see gold as a core asset for safety, inflation protection, and portfolio stability. Every time gold dips into major discount zones on the weekly chart, institutions accumulate heavily, absorbing liquidity from retail panic selling and preparing the next major upward push. And this cycle has repeated many times throughout history. Right now, gold is positioned in a zone where long-term buyers are active, and the recent corrective movements appear more like liquidity sweeps rather than trend reversals. The market structure shows that gold is still respecting its higher time frame bullish trend line, a sign of sustained strength, but gold's path is never linear. It consolidates, retraces, traps traders, and then explodes. The long-term chart reveals that gold is currently building another compression pattern, a tight coil where price narrows into a wedge-like structure before choosing direction. Historically, whenever gold enters such a compression zone after forming a strong bullish leg, the breakout is usually in the direction of the dominant trend, meaning upward. However, the breakout timing depends on macro catalysts such as central bank policy shifts, inflation cycles turning, or geopolitical escalation. Long-term market structure also shows that each correction gold has experienced over the last several years has been shallow compared to previous decades, indicating that global conditions are creating persistent demand for gold. With rising global debt, currency devaluation risks, and geopolitical instability, gold has evolved from a traditional safe haven asset into a strategic long-term hedge for countries, institutions, and investors alike. The monthly chart exposes a powerful bullish continuation pattern, price forming strong bullish candles followed by controlled consolidation phases, each leading to new highs. At the same time, gold's long-term bullish outlook is supported by the constant accumulation from central banks that are diversifying reserves away from the dollar. This steady demand creates a structural floor under gold, preventing deep collapses and sustaining the long-term trend. But for gold to reach new all-time highs again, it must hold above key support zones and break above the critical resistance region that has capped price several times. This region acts as a psychological and institutional barrier where both long-term buyers and sellers engage in massive volume battles. Once gold breaks above that ceiling with a strong weekly close, a fresh macro level expansion phase can begin, pushing gold into price discovery where targets can extend dramatically higher. But this long-term outlook also requires understanding where gold can retrace. If gold fails to hold above its higher time frame support, a deeper corrective leg could form, sweeping liquidity below previous lows before reversing. Such corrections are natural in long-term trends and often represent buying opportunities. The key is recognizing whether the correction is structural or impulsive. Structural corrections move slowly, with controlled pullbacks and well-defined support, while impulsive corrections break levels violently and show panic selling. Right now, gold's correction behavior appears structural, not impulsive, meaning the long-term demand is intact. Long-term moving averages such as the 50-week and 200-week are also sloping upward, demonstrating that the broader trend remains strong. These moving averages often act as dynamic support, and gold frequently bounces from them during long-term expansions. At the same time, Fibonacci long-term retracement levels align with critical historical support zones, creating powerful confluence that institutions respect. When gold aligns with these confluences, it often marks the beginning of large-scale accumulation phases. Traders looking at the long-term picture must also consider how global financial cycles influence gold. Throughout history, Gold tends to surge during three major cycles: rising recession fears, weakening currency conditions, and global instability. Right now, all three cycles are developing slowly in the background. Economic uncertainty continues to rise. Several currencies are weakening against the dollar, and geopolitical tension remains elevated, all of which lay structural groundwork for long-term strength in gold. But even with these bullish edges, gold faces resistance areas where long-term sellers attempt to push price downward, especially during periods of strong dollar performance. These attempts create temporary reversals, but rarely break the long-term structure. Gold also has a habit of sweeping liquidity above major highs before pulling back, meaning that even if gold hits a new high, a temporary correction may follow before the next wave begins. Long-term traders need to understand that gold's movement is engineered by smart money, which accumulates positions slowly, manipulates liquidity zones, and triggers emotional reactions in retail traders before continuing the larger trend. Right now, gold's smart money behavior suggests accumulation. Long wicks on weekly candles indicate that buyers are absorbing heavy sell orders at critical levels. As long as gold continues forming higher lows on the weekly time frame, the long-term bullish structure remains intact. The next phase of gold's long-term journey will likely be decided by whether price can break above the macro resistance zone that has held for months. If it breaks with a strong weekly candle and retests successfully, gold can enter a new era of price discovery where targets extend significantly higher. If gold rejects from this zone, a deeper retracement may occur, but even such retracements tend to form bullish continuation patterns in the larger trend. Long-term volume also supports the bullish outlook, with institutional buying increasing during dips. Global capital flows indicate growing distrust in fiat stability, further boosting gold's long-term strength. While short-term volatility will always shake markets, the long-term direction depends on structural forces, global risk cycles, monetary policy shifts, and institutional accumulation patterns. Gold is positioned at a moment where these forces are aligning in a way that supports continuation rather than reversal. Traders and long-term investors must understand that gold's journey is not measured in hours or days, but in months and years. The chart right now is telling a story of a market preparing for its next macro-level expansion. Whether it happens soon or after one more liquidity sweep, the long-term bullish structure remains intact. Gold is sitting on the edge of its next major chapter, and this 1,500-word analysis captures the entire long-term landscape that will shape XAUSD for months and years to come.